Today, I have a very special guest with me, and this is Matt Cunningham. He is founder of C&S Lending. I've gotten lots of questions from buyers, sellers, especially this time of year right now. What's going on in the market? And I wanted to bring on someone who has almost a decade of experience just to chat about what we're seeing now. What type of loan programs are available right now for beyond conventional, FHA, VA? Is there anything else that you're seeing, any products that people are leaning towards right now? Yeah, feel free
You
to
said
share.
beyond conventional FHA, beyond the normal loan
Yeah,
products?
sure.
Yeah, I mean, so I work with 270 plus lenders. I have between 3 and 5,000 products on any given day, and I do commercial, real estate,
Okay.
shared work, live spaces, anything, land. I can do just about anything. The fact of the matter is, probably 90% of all loans are conventional FHA, USDA, right? Most people fit into those boxes, and it makes sense for people to go with those products. They get the best rates, so on and so forth. I would say outside of those things, USDA was something you didn't mention. USDA is currently shut down because it's a government product.
You expect
But
that to change? Any thoughts on that?
You watch the news and you tell me.
I guess we're
I
all
don't know.
waiting.
Yeah. I'm sure it normally resolves itself quite quickly. But there'll be a bit of a backlog. And USDA is one of the products where when you get to the end and you've got the file ready to go and you're ready to clear to close, it has to go off to USDA and they have to approve it. So if you get on the USDA website right now, it says they're reviewing files from, and it's like, October the 3rd or whenever they stopped reviewing files. So there's going to be a 5, 6, 7, 8 day lag, or whenever they finally get to it. So, but USDA is still a great product, and if you got a 30-day close, there's still plenty of time to do that, hoping that everything opens back up. Other than that, typically, for self-employed income, right? A lot of self-employed folks write off a lot of business expenses, which makes sense. You got to pay less tax. But you can't, you can only use the income you claim as income, right? There's that old catch. So a lot of times self-employed people will tell me that, I made $250,000 last year. Great. We start looking at homes. I get their financial documentation and they wrote off, 180, and it shows they make 70,000. So in that case, we would go non-QM or non-qualified mortgage, and we could do a bank statement only loan to show their income. So 12 months of personal bank statements or business bank statements. The types of loans, it's all about risk, right? So credit score makes a big difference. You want to have a good credit score. Kids out there.
I'm sure you see quite a range. What is the lowest you can work with? I know there's people listening now who know they've got to work on their credit. What can they be doing to get it higher? And what's the lowest you can work with?
Good, great question. So credit score runs between 300 and 850. And the credit scores that we pull Experian, TransUnion, and Equifax. Those scores come in differently and often a little bit lower than it's called your FICO score, right? Your mid score. The ones that you get on your bank app or we call that a FACO score. It's usually a little bit elevated. To do an FHA loan conventionally through lenders with the best rates, you're going to need to be a minimum of 580 credit score. You can do an FHA loan. FHA rates and 5/1 ARMs and 3/1 ARMs, which I can explain in a bit, those rates are so much better right now. I'm actually refinancing conventional buyers into FHA 5/1 ARMs, or I closed a purchase with an FHA 5/1 ARM. Yeah, because you're looking at 6 months or so ago, instead of a 7.25% interest rate conventional, if they're only putting down 3% or 5%, they're still paying mortgage insurance anyway. Go with a 5/1 ARM. Now you're at a 5.75% interest rate. And the conventional loan limit currently in Georgia is $524,225. So it's about a what's that about it? Well, you can put more money down and increase your sales price. But it's about a $550,000 sales price. That goes up to over $1 million for an FHA loan for 4
Wow.
units if you take one as a primary. So that's a great option for people if they're looking to invest. So 580 FHA, you can go, you can be an 820 and go with an FHA loan if you don't have an FHA loan already. For conventional, to start getting decent rates, you're going to at least want to be 640, 650, preferably 700. You can do a conventional loan in the high sixes, mid to high sixes, but your rate's still going to be a bit stinky. And then USDA, 640 is the minimum score for USDA. And then, of course, the products vary with debt to income ratios too, which is probably a conversation for another time. But yeah, I'm putting a lot of borrowers into FHA loans if the loan amount is small enough that the max amount, just because the score. So a 5-1 arm means the rate is locked for 5 years. And then after 5 years, the rate can go down or up by as much as 1%. So if they're locked in at a 5.625, after 5 years, if rates keep going up, they might jump to a 6.625, or they might fall to a 4.625. The hope is that rates continue to go down a bit. And in 12, 24 months, we can refinance them into a traditional 30-year conventional rate, and everyone's happy. But it just depends on it. All buyers are different too. It depends on whether or not they're payment sensitive, or equity, someone wanting to pay down equity. Some people don't care how much the payment is. I just refied someone I was going to refi them into an FHA 5-1 arm, and we got looking at it and figured out they were more equity sensitive. They would want to pay down that equity and own their home. We put them in a 20-year, so I was able to decrease their payment by $600 or $700 a month. But they wound up increasing their payment by about $100 a month to refi from a 30, which they had 29 left on, into a 20. And at the end of this year, rather than having paid off $7,000 of equity on the loan this year, they will have paid off $16,000. Next year, instead of 7.5, they'll pay off $18,000, and so they're gonna pay the loan off much quicker. And so it just depends on what buyers want. A lot of buyers in this day and age, with the federal interest rate and the cost of goods and everything so high, want as low a payment as possible.
Now, I'm getting personally from buyers a lot of questions about down payment assistance. Right now, I'm seeing various programs with various lenders. What's your suggestion about that? Obviously, it sounds very appealing to have down payment assistance. And I'm just curious what your thoughts are in the various programs and how that works, so people can clearly understand.
Yeah, down payment assistance is typically going to be used with an FHA loan. It's usually for people that have it's a bit like playing whack-a-mole. Once you fix one thing, something else pops up. Once you fix that, something else pops up. So you can't have no money, bad credit, and low income and buy a house at all, really, right? You gotta have decent credit. You gotta have a bit of money saved so you can pay closing costs and down payment, and you gotta have income so that you can prove the ability to repay, is what lenders call it. So you can prove that you can make your payment. With down payment assistance, you almost have to have at the least decent credit. I'd say somewhere between 580 and 620. You have to have pretty good income.
When you say pretty good, what are you?
Right, so it's a ratio. Your debt to income ratio, DTI, is how much you owe each month versus how much you make. And with FHA loans, you can borrow up to 55% of your income monthly. So say before tax, you make $5,000 a month. You can borrow a total of a little more than $2,500. What is that? $2,750. There's a mortgage guy. $2,750 a month of the $5,000.
Yeah.
Now the $5,000 is before tax. So you can borrow up to $2,750 after tax each month, and that includes your car and your student loans and your credit cards and all that good stuff. Minimum payments on credit cards. So if your debt, so when I say if your income's good, I mean if your income is high enough and your debt is low enough that your DTI is 35%. Once you factor in the new home loan as well, or not even 35, call it 40, 45. But typically, let's say you're making $8,000 a month, right, before tax. Your DTI is 4,400, I think, 55%. Your debt to income ratio, or rather your DTI is 4,400. That's the max. If you're already got a $400 car payment, now you're at 4,000. If you've got 3 credit cards and the minimum payments are 100, now you're at 3,700. Let's say you got a student loan, we got to factor in another 450. You go from 3,700 to 3,350, 3,250. So now we've got to get you the mortgage payment for 3,250 or less. So if you want to go down payment assistance, your interest rate is going to be much higher, because interest rates are affected by risk. The credit score is the number one indicator of risk. And then it's the type of product, right? So the bank statement loan that I talked about with
non-conforming.
Non-conforming is going to be riskier and hence higher interest rate. So now you're doing a down payment assistance. The down payment part, let's say you purchase a home for $400,000. It's 3.5% down with FHA, which is 14,000 down. So that's going to be the down payment assistance amount. That chunk is going to be at a much higher interest rate than a normal FHA loan. So instead of a 5.9, 5.87, it's going to be a 7.5. And the whole rest of the loan assumes the same interest rate. So,
there's a lot to think about too. I don't know if you really crunch the numbers, and it's all in the details, really.
It is. And look, most borrowers don't need all of this information, right? So that's another thing too, is as a loan officer and as a real estate agent, you're constantly kind of getting to know developing that relationship with your client, because you want to understand what's important to them. And I hate to say how much they need to know, because you're not intentionally withholding information from them. You want to be transparent as far as costs and closing costs and what fees are in there, and there's no hidden fees, but you also need to give people the information that they're looking for with which to make a purchase decision, right?
So for example, I remember when I was purchasing my last property, I had to choose between 15-year, 30-year. What are the benefits and differences, and how do you explain that to your clients?
So every question, everything that I want to explain, it starts with a question, right? So It's like, what are your goals? How long are you going to be in your home? How long are you going to be in your home?
4 years.
4 years. Okay. Are you payment sensitive? Do you mind if your payment is $1,000 higher?
I'm only keeping this for 4 years, for example.
Right.
So would I be?
Well, so here's why I'm asking that. If you go with a 30-year product, your interest rate is going to be okay. You're not going to pay down the equity much in the first 4 years. It's a 30-year product. Most of your interest is paid in the first 7 to 10 years, and then that ratio of interest to principal that you pay each month changes, and so you pay more principal out over time. If you went with a 15-year instead of a 30-year, let's say your 30-year payment is $4,000 a month. Your 15-year payment might be $6,000 a month, right? So you might pay $24,000 more per year, but you might pay your equity down by $30,000 more each year. So you're $6,000 ahead. So it's a good thing from a financially astute standpoint, right? You're saving more money over the course of 12 months, but it's because your payment is bigger. Which do you want, right? And then, of course, there are lots of options between them. I actually have a one lender that I can curate the length of the loan. So I can do anything from a 30-year to an 8-year loan. And I can look at 15, I can look at 17. I can, if you want 24, because you can afford that payment, you don't want 30 and you want to pay the equity down a bit more earlier on. And then, as the term of the loan decreases, the interest rate usually gets a little bit better too.
Wonderful. Now, I'm getting a lot of this recently, and there's various programs, and I'm aware of these, but I'd love to hear from the experts, since I always defer my clients to lenders such as yourself who are very knowledgeable about this. But a lot of people have to sell in order to purchase their next property. It's been the case for the last few years. I know a lot of sellers have been holding on to their property because they've got that amazing mortgage rate that I know I don't have, that I wish I did, that I'm not sure we'll ever see again. I don't know what your thoughts are on that. But what's the program you're most excited about? I know bridge loans can be pretty costly. There's various buy before you sell programs. What is the best strategy that you're seeing work right now for those clients you have that really they can't purchase a home without selling theirs? And I can tell you, sales contingencies in Metro Atlanta, we haven't really been seeing a lot of that right now. Maybe now that the market has cooled off a little bit, but in the past, historically over the past few years, I don't see a lot of properties going under contract with a sales contingency. So
Right.
I'd love to hear from you which product you're kind of most excited about right now for those individuals.
Probably the most difficult question to answer so far that's going to make everyone happy.
We got to know the truth though, right? To make smart decisions, it's important to be educated. So I know a lot of people are scared to even ask. They don't want to know. So there's a lot
of products like bridge loans that are, and the down payment assistance and non-QM that we talked about. And at the end of the day, they all serve a need, but they're all a little bit of a band-aid that we're putting on a problem, which is riskier and it's not financially ever as sensible as just being able to purchase a home with a conventional product and having the money to put down. This doesn't make sense. So my first question with buyers that are in this quandary,
I'll be your sample buyer.
Okay, good. Go easy on me. If I would say to you, look, you're in a $750,000 home right now. You've got a $500,000 loan. You're at 2.75% from back when things were ridiculous, right? So your payment is at $500,000, 2.99% or 75 or whatever I said. I mean, your principal and interest is going to be $3,700 or something crazy, $4,000, call it. I'm good at math, but I'm not a mortgage calculator.
Really? Because I could swear that you are, because these numbers are just rolling off your tongue. I'm trying to keep up mathematically.
That's only because I can make things up quickly. So let's say your payment's $4,000 a month. If you move from a $750,000 home to a $1.2 million home, and you take that $250,000 of equity and put it in there, you now have $1 million loan, not at 2.75% interest rate.
Totally different scenario.
First of all, we moved, so I threw a wrinkle in there, right? We moved from conventional to jumbo, so that rate's going to be a little bit higher still. But I mean, a good jumbo rate right now, let's say you're at 5.99. It's double the interest rate. Your payment is going to go to, the principal and interest is going to go from $4,000 to probably $8,000.
Wow.
Just the payment, right? So yeah, there it is. Wow. So that being said, I always challenge the buyer. What do you want? What do you want?
That $1.2 million house, so I'm willing to do it.
Okay. So then, it's a question of what do you really want? Well, I love my home. My rate's great, but I want to live in this one. Okay, well, how bad do you want to do it, right? How bad do you want to afford a $4,000 increase each month, plus the taxes and insurance, which is going to be higher too on a more expensive home, a little bit from 750 to 1.2. So that's the question I'm not going to talk anyone into doing something.
So
But
it's
so that's
really about educating the consumer and having those conversations and truly having a relationship with your clients so you get to know what they need. And that's what I do as a realtor as well. And I love to, if I have someone I want to connect you with, I'll share with you their background and what they're looking to do. And you are the expert. So it
right,
really matters. And I'm seeing most people downsizing who have that great rate, who are not necessarily
right.
looking for the higher ends. They're looking to downsize, and
Maybe they're empty nesters too, and they
yes,
just don't need as much. And
they
yeah,
don't,
it's a
but
good.
they've got a great rate right now. So what do we say to those folks? A lot of them baby boomers, looking to downsize, looking for a ranch home, master on the main, and they've got
What
such
I say to them is
beautiful rate.
that's a great idea. I'd love to take care of your loan. Yeah,
Right. But
absolutely. I
they're
think
going
it
to
is a good
be
idea.
now, yeah, because I've seen a
I,
lot of people. Go ahead.
I didn't answer your question about they're afraid to sell and
Mm-hmm.
they're ready to buy. Yeah, I mean, at the end of the day, um, it doesn't matter what kind of market you're in. There's always that fear, right? Oh, I don't want to go out house hunting because my house isn't even ready to list. And it's like, what came first, the chicken or the egg? Get your house ready to list it, and go house
Yeah,
hunting, and then just try to get them closed on the same day. Like, and it happens all the time.
it
It's
does.
amazing.
It does. And it is
Sellers and
possible.
buyers, yeah, people understand that. Yeah, well, I got to sell my home. Can we make the closing date 38 days from now instead of, because I've already under contract? Yeah, that's fine. Like, if you want to accept the offer, accept it. And that's where great realtors come in, is with the
Right?
ability to
Navigate
negotiate.
them
Yeah,
through the
right,
process.
right. And make sure that that they explain to the seller's agent why this buyer is the best person for
Exactly.
their sellers, if they are. And so, it's interesting. The more we talk about it, the more you realize it's numbers, right? It's sales price. It's trying to sell this house. How much
Mhm.
equity? It's the loan. It's the numbers. It's people. It's
Mhm.
communication. It's
Correct.
having a real estate agent that's going to go to bat for you, is going to negotiate
Correct.
firmly but fairly, um, fully understands what their buyer wants in order to be able to
And what do we
negotiate.
need in a lender?
Yeah, or what their seller wants and what do they need
Yeah.
in a lender, which is obviously just
Right.
right here.
And that's why I love partnerships with people like you, because I love working with lenders who know this business, who I know I can call on the weekends when I'm putting in offers and trying to navigate the best time to close and the best time. It's great to have that communication and have a great team of agents, a realtor, and a lender who can help them navigate through that process. So, looking forward to doing more business with you this year, and regardless of what's going on in the economy. And I really appreciate you taking time out of your day just to give us a little snapshot of what you see day to day. And
Well, I appreciate it. It's been a lot of fun. I'm sure the demand from the public will dictate that I'll be back soon.
yes, I can, yeah, it will. Well,
Yeah,
thank you
we'll
so
see.
much. And you have a wonderful day. And hopefully, we'll get you back on here to answer more questions as they come in.
Thank you very much. Appreciate it.